Welcome to episode 277. Ken Griffin, the prodigy trader from HarvardDorm and the founding of Citadel. This is an outline of episode 277. There are 3 reasons why we study Ken Griffin. First, Ken Griffin is a prodigy trader. He started his interest in the stock market at grade 6. Second, he's one of the most successful hedge fund managers of all time. Third, he almost has no losing streak. An amazing consistency. Ken Griffin was born in Daytona Beach, Florida in 1968.
Helpful to share a bit about myself. Let's take a journey back through time. Yes, this is me on the beach as a young boy with the business section of the paper. And here's a report that I wrote in 6th grade where I set out to understand how the stock market works.
At age 19, Ken Griffin started a hedge fund in his Harvard dormitory. The fund was capitalized with $265,000 from friends and family, including money from his grandmother. Here's a picture of his very rich grandmother.
I have to admit that my early days were a far cry from overlooking Central Park or for how this industry is often portrayed. I finally remember installing a satellite dish on my dorm room at Harvard. I got on the rooftop, I threw the cable through the 4th story window, down the elevator shaft, and out the door of the elevator into my dorm room so I could have real-time stock quotes. And between class, I would find payphones to try to trade convertibles. Drove the brokers a bit nutty. Now, when I went to liquidate my options, the market maker paid me $50 less than their intrinsic value. And his trading approach really got me interested in learning about the pricing of derivatives. I used to walk across the river to Harvard Business School where I'd spend hours in the library reading books on derivatives and trying to understand the pricing and financial theory behind derivatives. And I came across a strategy known as convertible bond arbitrage. Now, I'm in Boston.
In 1989, Ken Griffin graduated from Harvard University with a bachelor degree in economics. He was 21. Then he was lured to Chicago by Frank Meyer.
Frank was one of the great pioneers in the fund-to-funds business, and Frank took a huge bet on me. He hired me out of college in 1989 and gave me an opportunity to manage money for Glenwood Partners. We had a pretty simple understanding. If I did well, I could leave Glenwood Partners and strike out on my own, and he would support me. And if performance wasn't so good, he'd write my letter of recommendation for business school.
More about them, and then in 1973, I teamed up with another partner and became active in the fund-to-funds business. I'm proud, too, that it's become a business. You know, when I was out there initially, I had to convince people that it was a business.
What is it that you think seeders or people that are early stage investors should look out for when looking at a new upcoming manager?
I think you have to look at the manager and see, what are his strengths, what are his weaknesses, and to the extent that he has weaknesses, and all of them do, how is he going to compensate for the weakness? I mean, basically, when you're a money manager and you're leaving working for someone else and going on your own, you have to manage a portfolio, but you also have to manage a business. So I think it's important that you see a manager that shows breadth, that he respects the parts of the business that he doesn't know that well as the parts of the business that he does know.
In 1990, he founded Citadel hedge fund with $4.6 million, $1 million of which was from Frank Meyer. He was 22.
But Frank offered more than capital and more than moral support. He gave me great advice. He said, don't focus on just a single investment strategy. Focus on building a firm, a platform that attracts the best and brightest people and that deploys capital across an array of investment strategies. Think big. And I took his advice to heart. And I spent a lot of time focusing on hiring the best and brightest people. Well, with Frank's support, in the November of 1990, I did launch Citadel. And within a few short years, Citadel was engaged in a wide variety of investment strategies, such as Japanese equity warrant arbitrage, merger arbitrage, and statistical equity arbitrage. How we rose, how we prospered, how we nearly failed, and how we recovered to prosper again. I'm going to focus on three important concepts, three themes that are part of our story: the importance of talent, the importance of execution, the importance of taking decisive action.
Citadel became the largest market maker, issuing its own bond, and controls about 7% of total trade in the entire stock market.
The rescue of E-Trade in the fall of 2007, which included a $2 billion capital infusion led by Citadel. And Citadel has become the largest equity and options market-making firm in the U.S. markets, if not the world.
On a Sunday morning, in the summer of 2007, one of my partners received a call from one of the two heads of SoHed Asset Management, a competitor of ours based in Boston. SoHed had a very large and complex book of credit-related instruments. And as the credit crisis started to unfold, they found their portfolio did not behave as expected. They had lost hundreds of millions of dollars in the blink of an eye, and they needed to liquidate almost all their portfolio before the open of business on Monday to meet margin calls. We assembled a 50-person team as fast as we could. We flew 8 people to Boston to facilitate due diligence and information sharing, to acquire some or all of their $30 billion portfolio overnight was going to be a Herculean.
In 2014, he was the highest paid hedge fund manager in the world, earning $1.3 billion. In the same year, he donated $150 million to Harvard University, his alma mater, and that was the largest donation Harvard ever received. In 2017, Griffin donated $125 million to the University of Chicago Department of Economics. So, what is the magic formula for success at Citadel Hedge Fund?
Do two things. Number one is we work together as a team. We have long since moved past the day and age where one person on their own is likely to have the impact that we're looking to accomplish in the financial markets. Our great success stories are team stories. The second dimension is that we're extraordinarily focused on how do you build competitive advantage in everything you do. How do you think about everything we do, how do you do it better than the competition? Because if you're not better than the competition, you have no reason to exist. And in particular, I think we live in this very unusual winner-takes-all world more and more, where your market leaders really do dominate. You know, I say to my colleagues, who's the 5th largest manufacturer of personal computers? Now, almost no one knows, and frankly, no one cares. So we're in a world more and more where the best firms know how to hire extraordinarily good people, create a culture of teamwork, and have a relentless focus on how do you build competitive advantage. And competitive advantage comes in all kinds of forms. So in every part of our business, we're always trying to think about what is it that differentiates us from our competitors. Better predictive analytics, more specialized research process, better management access and coordination, better information sharing. We're always thinking about how to build competitive advantage. And I think that's different.
What have I learned today? 2 things. First, wow, it's possible to start a hedge fund in the dormitory of Harvard with high tech and curiosity by a 19-year-old. Second, still in his 40s, Ken Griffin will be a force to be reckoned with in the decades to come. Thank you for watching. Please subscribe and leave your questions and comments below. My next video will be 14 trading lessons of Ken Griffin. Wishing everyone peace and prosperity.